You're tuned in to Agriculture Today, and we start our Friday show talking about market terminology with K-State Extension Assistant Rich Llewelyn and K-State Grain Economist Dan O'Brien. Rich, Dan, thank you both so much for taking the time to join us today.
Thanks for
Thanks,
having us.
Shelby.
Wanting to talk through a few terminology or terms that we often use when we talk about the market. And the first one, talking about basis.
I'll start in. Uh, Basis is defined as the difference between the futures price for a commodity and its cash price at a specific location. And generally, when we're looking at the cash market basis, we're looking at the difference between the current cash price, say in Beloit, Kansas, versus if it's for corn, then the CME lead futures contract. And there are different terminologies for basis. In terms of a weakening basis is one that's getting wider. The local cash prices is lower relative to futures. Strengthening basis, you'd have the opposite, where the basis is where the local cash price is getting closer to those futures, and you will run into situations where you have uh, an even basis, or in some amongst farmers, amongst the grain industry, they'll call it par, basically, where the cash price and the futures price are local cash price and futures price are equal. And a positive basis or over basis is again where when the local price is higher than futures, and we have that actually almost as a standard situation in the Garden City area for corn. Strong demand center in the state, and so we generally have positive basis there, or a lower basis, and we've just seen that occur. Well, you tend to see that in times when we have more than adequate local supplies, and the price tends to go lower. I would add in, we keep track of basis, grain basis, on our Ag Manager website. Rich, you want to talk about that a minute?
Yeah, we have a both a basis tool and some basis maps that we do weekly. It's the Wednesday close of the markets, and so then we collect that data for grain elevators around Kansas and around the region, actually, in surrounding states for the four major crops, so corn, grain, sorghum, soybeans, and wheat. And we post that. And what it shows is where prices are relatively stronger compared to the futures prices, and where they're relatively weaker. And that can provide information for marketing. It may be that there is an elevator that's not that far away, but it's giving a better local cash price. And so paying attention to basis can be quite helpful, actually.
And it does show that tool does show basis history, where we've been in the past year, so we can have some picture or some idea of relatively stronger or weaker basis levels.
And we actually have on there, you can compare it to the current basis to the average of the past 3 years, or the past year, or the past 5 years. And so you can kind of see how are we doing right now relative to historical trends.
And something else we wanted to talk about today, really maybe to just make people aware of these different terminologies and what they really could do to impact the market, import tariffs.
And I'll take that one. This is something that has been proposed by the new administration that's coming in, and it could have some effects on agriculture and on the overall economy. And it's in response to some of the things that other countries have been doing as well. Import tariffs basically they're a tax on goods or coming into the country, and so they raise the price of goods that are coming in. The purpose in many cases is to raise revenue for the government, but also to help with domestic industries, and to protect them from competition from abroad. Now, in the case of agriculture, uh, import tariffs on goods coming in, there's not a lot of agriculture products that will probably be taxed like that, but the effect for agriculture could be what other countries do in response to something like that. And so it would raise the price of our agricultural products in other countries, perhaps, if they respond and increase tariffs. In fact, a lot of agricultural products that we send abroad already are taxed in those countries. And it could make that even higher, making it more difficult for agricultural exports. What it does domestically is it raises the price of those goods in the country. And so for goods coming into the United States, if there are import tariffs, consumers here would pay more for them. And we would have the local industries being able to better compete, perhaps, but at a higher price and a higher cost to consumers.
And I would add into that, you look at a country like Argentina. Argentina has in order to raise governmental revenues, again, one of the main commodities that Argentina produces would be agricultural commodities, soybeans. So they have export taxes on soybeans, but not on soybean meal. So those taxes in that country kind of distort. I shouldn't say, well, they impact. Some would say distort whether the raw beans are sold or the processed products are sold from beans. There are export subsidies that some countries have, special incentives such as cash payments, tax exemptions, preferential exchange rates, etc., for different goods that company is trying to export. And in China, there was an export subsidy for used cooking oil that just came off. And this is, of course, U.S. soybeans oil producers, look at that as gosh, a government subsidy for a product that directly competes with them. So you've got these issues all at play. Uh, there are, I guess, something that can be more subtle, Rich, or export licenses or phytosanitary regulations. I'm kind of throwing that in your lap. Do you want to talk about how that can impact trade?
Well, and some of those licenses are used regarding environmental issues or regarding food safety issues. GMOs in Europe have been subject to some of those things. And so there's been a variety of policies that affect trade and then affect the producers and consumers of those commodities, both in the country receiving them as well as the country sending them out.
And phytosanitary regulations can be something can be kind of subtle trade barriers. They say, well, I don't like the GMOs that you have over here, or I don't like the exposure to a certain disease over there. Well, it could be a subtle, quasi sneaky way to limit import competition from another for to protect your own industry. So there are, I guess. When you get looking at trade, it's a hardball situation where a lot of people a lot of countries are seeking to protect their own industries.
And something else that we always talk about when we talk about the grain market and the cattle market futures, and can you give us a breakdown of some different terminology that's commonly used?
So, Rich, I'll start in on that one real quick. So, generally, futures prices are the value of a commodity at a point in time, determined through open negotiation and competition among buyers and sellers at a trade. Uh, where we used to say on a trading floor in the exchanges, well, now we've transitioned largely to electronic trade for all of that. So it's on a trading platform, which is a nice way to say it's computerized. But anyway, you have that, and for instance, it wouldn't be uncommon to see December 2025 corn at say $4.50 or $4.25 or $4 setting here in early January 2025, looking all the way out there. So that's an estimate of what supply demand conditions will drive prices to. So that's a far distant price. Current and you have more current supply demand factors represented in the more upfront or lead contract price. So at this time, it'll be the March 25 corn contract that we're looking at, and we could have the same discussion with regard to the other commodities that we're looking at. And Rich, I'll just throw this out and let you comment on any of that you want. When you talk about futures, we talk about the opens or the opening price for a trading session, their close, the last price for a trading session, settlement price, the midpoint of a closing price range. When you look at the internal, we see kind of a cleaned up version of what actually happens with all those trades, those thousands of trades that happen. They give us one price that they settle on, and it can be a mess. It can be, let me say that more scientifically. It can be difficult to deduce what exactly that last price is. So, Rich, any other comments?
Well, just one on the limits of price moves in each day. There are limits on the futures markets as to how far a price can move in any one day. For corn, for example, I think it's 30 cents per bushel is the limit. And then if it hits that limit one day, then the following day it's actually twice that, and it's allowed to move even more if there are major market moving factors going on. So that's something to be aware of as you're operating in the futures market. One of the things that people do pay quite a bit of attention to is the harvest contract for grains. So for that, for soybeans, that's generally considered to be the November soybean contract. And then for corn, the December contract is usually considered the harvest contract for corn. For wheat, it would be the July contract for hard-bred winter wheat.
But then in reality, and for hard red spring wheat, again harvested later, it's basically the September contract.
Right. One other thing for Kansas here is that grain sorghum doesn't have a futures contract. And so corn is usually used as the proxy contract to kind of fill in for the grain sorghum. And so we a lot of times will calculate our basis. In fact, not lots of times, all the time, we'll calculate basis based on the corn futures contract and the sorghum cash price.
We economists would refer to that as a form of cross hedging, but it's pretty close cross hedging. It's not grain sorghum being a competitive feed grain with corn in many aspects. Again, trades off the same contract as Richard said.
Dan, Rich, I appreciate you both taking the time to join us today.
Thank you.
Thank you.
That was K-State Extension Assistant Rich Llewelyn and K-State Grain Economist Dan O'Brien. We're cutting to a short break now on Agriculture Today, but when we come back, we'll once again be joined by Dan O'Brien for this week's Grain Market Update.